Dividend investing has been one of the most misunderstood parts of the financial market for many years. Some say it is a way to get a steady side income, others consider it a waste of money and not a quote-unquote real investment. But the thing is, not only is dividend investing just as valid as any other kind of investing, but in the right hands and with the right tools, it can be far more profitable than anyone has ever told you. And seeing as you have clicked on this video, I'm willing to bet that you know that and are interested in learning how to maximize your profits. So strap in, because today we are going to be looking at 6 of the tried and tested methods of maximizing dividend returns. And I'm not talking about run-of-the-mill basic tips. These are industry-standard technical tools that will not only make you better profits, but will turn you into better investors overall. So without further ado, let's jump right in with number 1. Be careful of high dividend payout ratios. One of the most well-known tips given to new investors is to look out for companies with a dividend yield that is unreasonably high, because they're most likely trying to trap you into a failing business. But the thing is, that is not the only way to trap people in a failing business. In fact, many failing companies might still pay out regular dividends by sacrificing their own cash, so everything seems fine when it really isn't. In those cases, it is useful to look at a company's dividend payout ratio, which is the ratio of the money the company pays out as dividends to their earnings in that same amount of time. And if that ratio is too high, it probably indicates that the company is paying more dividends than it can, signaling an oncoming bankruptcy. In general, any payout ratio of greater than 50% is guaranteed to be a scam. And even then, it is advised that you shouldn't go over 20% for long-term investments. Number 2. Make investments periodically. Now, the previous tip is how to ensure you're investing in a stable company, but there's also a lot of technique involved in how you invest in the said company. Most of us are tempted to invest immediately and head first whenever we find a good company and then manage that investment over time. Similarly, most of us are also inclined to save up some money for investment before actually jumping into the market, which only wastes our time and doesn't accomplish a lot. In these cases, the best thing to do is not to invest all at once, but invest after a specific interval, regularly. This can be a weekly cycle, a monthly cycle, or even a quarterly cycle. And this is not just for adding money to your portfolio after these cycles. Instead, you'll reevaluate each of your stocks after every interval. This behavior has been experimentally shown to not only increase your likelihood of success, but it will allow you to learn and gather experience from the stock market far more thoroughly. And it will also have another added benefit, which I'll explain a little later in the video. Now, these have been pretty regular tips, but now we are going to get into specific technical stuff, so you better get ready. But before we move on to that, if you've liked the video so far, I'm willing to bet that you'll also like our other investing related content. And if you are interested in that, please consider liking the video and subscribing to us so we can continue to provide quality financial content to viewers like you. With that, let's move on to the next step, which is number 3. Always retain your initial capital. As you'll invest and grow your portfolio, if you do everything correctly, you will start to grow in both value and experience. But with that experience, there will come a tendency to be a little more reckless. And in these cases, seasoned dividend investors recommend that you keep one simple rule in mind. You can invest in anything you deem worthy as long as your initial investment capital is saved. Of course, this will be harder when you start out, but as your portfolio worth increases, slowly transfer at least your original investment to good stable stocks, even if they pay low dividends. The reason behind this is simple. Since dividend payments are taken out every cycle, there are very few ways to lose money in dividends, and one of them is losing the money in failing ventures. But as long as your initial investment is safe, all your other ventures can fail 100 times but not cause you any direct loss. And speaking of dividend payouts, another crucial part of a dividend investing strategy is number 4. Be mindful of commission costs. This might sound like a no-brainer, but you'll be shocked to know how many excellent investors lose unnecessary money just because they're investing via an overpriced client. Now, in the beginning, it might make sense to pay a little extra commission for extra features. But as time goes on, you should never be afraid to switch clients for your benefit. Hell, if you end up experienced enough, you can even invest via zero commission services. After all, it's your money, and in the world of investing, every penny counts. Speaking of pennies, one of the most powerful but least understood tips for all investors, but dividend investors especially, is to number 5. Learn and apply dollar cost averaging. When most people hear about the dollar cost averaging strategy, they get overwhelmed and decide that it is probably too complicated to even try to learn. But the thing is, as fancy as it sounds, the strategy itself is very simple. It is the results that are astounding. You see, the goal of dollar cost averaging is to invest in small increments spread out over a period of time instead of all at once. Why? Well, by making sure that all your investments don't go all in at once, you're also making sure that you don't invest at too high a price even if accidentally. But even more than that, it allows you to invest while accounting for market volatility. You see, by investing multiple times at different market rates, some of which will be too high, some of which too low, you'll automatically end up investing at an average rate, getting you closer to the company's actual value instead of their inflated one at any given time. And sure, this might rob you of potentially stealing a deal at a low price, but if you know anything about the stock market, you'll know that prices are overvaluated far more than they're undervalued. And finally, the most important method of maximizing your dividend yield, and the simplest one, is number 6, prioritize dividend reinvesting and use DRIPs. Now I know that when most of us get into dividends, we are looking for a way to get monthly payments that you can then spend during your day-to-day living. However, you'll be shocked to learn how much more you could be earning if you would just periodically reinvest. So, as your yield slowly grows on its own and you start saving up at the end of each month, don't be afraid to put that money back into your dividend shares. But that's not all. If you're one of the people who are not using dividends as a primary source of income, you can instead get a dividend reinvesting plan or a DRIP. These are plans you get through your investing client that automatically invest your payouts into your accounts. And sure, the increase might be minimal at first, but if any of you have ever tried to learn about regular investing, you will have heard of the power of compounding and how it can increase your profits tenfold without a drop of input from your side. Now, to summarize, if you take care of payment ratios to learn about a business, invest in small increments according to a planned strategy, don't gamble away your base investment, and reinvest as often as you can, ideally a little more than that, you should be able to increase your dividend yields from a child's pocket money worth to a full-fledged salary. And while these tips and tricks only scratch the world of dividend investing, if you follow the basics of dividend investing and apply the tricks that I've told you in this video, I think it'll be more than enough to allow you to generate the profits of your dreams. And that basically covers our guide on how you can use the industry's long-kept secrets to improve your dividend investing game. And with that, we must pass off the question to you. You see, we're curious to learn about our audience so we can create content better suited to your needs. So I'd like to ask you guys, why are you interested in investing? To make it your full-time job, as a side hustle, or to build wealth in the long run? Do let us know down in the comments below. And while I have you here, if you're looking into things like dividends, you may also be interested in value investing. And if that's the case, check out a video on the topic right here. And well, on that note, we must end today's video. I hope you enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care, and I'll see you guys next time.